we're going to move on to the next session, which is Crown Financial Institute Responsible Investing in New Zealand. And our first speaker is Lucas Kengmana, I hope I pronounced that somewhat right, who's a senior investment strategist at the New Zealand Super Fund. He actually gave a great guest lecture earlier in the year, which is why we wanted to have him back for this event. And he's worked on the TCFD reporting. He worked on the Fonterra climate change strategy when he was there, and he's also sat on the Climate Change Commission. And today he's going to talk to us about the New Zealand Super Fund's responsible investment approach, which is seen globally as one of the leading entities in this space. So Lucas, if you're there, thank you for your time. Looking forward to your presentation.
Kia ora katoa. Thank you very much for having me to the University of Otago. Today I have the unenviable task of speaking before my boss. So to ensure that I don't steal his thunder, or even worse, say something that he'll later contradict me on, I've decided to change my focus a little bit from responsible investing writ large to climate change and net zero more particularly. As many of you may know, about a month ago, the Crown Financial Institutions committed to net zero and now have been joined by financial institutions with a total of 130 trillion US dollars under management who've made similar commitments. So hopefully this is equally interesting to all of you. But for anyone who is feeling just a little bit ripped off, I would just note that in many ways, what we're planning to do on responsible investing mirrors what we are doing on climate change. And of course, Johanna Dodds, who is speaking right after me, will tell you about what ACC is doing on responsible investment, and Matt Winneray, who is speaking a little bit later in the day, will share all the latest thinkings from the Guardians on responsible investment. So I just wanted to check that my screen is now being shared. Hopefully you can all see it. Okay, brilliant. So let's start from the beginning. Why does net zero matter? And what does the world need to do to get to net zero? So this kind of goes back to the Paris Agreement, where world leaders agreed to limit emissions to 2 degrees and try to limit them to 1.5 degrees. So, following that agreement, they asked the Intergovernmental Panel on Climate Change, the IPCC, whether limiting temperatures to 1.5 degrees was achievable and desirable, and if so, to give some advice on how we might get there. So the IPCC definitively concluded that while it would be very challenging to get to 1.5 degrees, the benefits of doing so far outweighed the cost. And then they provided the graph, which is on the slide here, to show how we might get there. And so this graph is a little bit complicated, I guess. The main things to take away from it is it's a series of pathways. So it's a series of different emissions pathways through time that would be consistent with achieving a 1.5 degrees change in temperatures. The blue area is the area that doesn't require what's called an overshoot. So that means that we don't have to go way beyond the total cumulative emissions, don't go way beyond our long-term target. We kind of stabilize, and there's a lot of reasons why that's desirable. It reduces a bunch of risks, and it's probably also more affordable. So a graph like this is pretty hard to digest. So to sort of convert it into more common language, they kind of pointed to 2 things. The first one is, as you can see in that first red circle, global emissions need to reduce by around about 50% between 2020 and 2030. And then the second big finding they brought up was that we need to achieve net zero emissions by 2050. And I say kind of because you can see that second red circle is actually quite wide, and there's a bunch of scenarios that achieve net zero before that, and there's a bunch that achieve it afterwards. But that is, that's where net zero really came from, and that's what we mean when we say that we're committed to net zero. Basically, it's shorthand for saying we are committed to following an emissions pathway which is consistent to achieving a 1.5 degrees world. Um, so going from, what does that mean for the world to what does that mean for investors? What do investors need to do? Well, we looked at this quite a lot over the last year, and it's fair to say that there's actually not one, but rather a number of different frameworks for that, sort of walk an investor through what might need to be made, what kind of commitments might need to be made in order to say that you are aligned with net zero. The most obvious is that the portfolio should really reach net zero by 2050. Two, it should set targets that are aligned with the pathway. So, it's all well and good to have a long-term commitment, but you also need to have shorter-term commitments, because we can't just get to 2050 and, continue to emit the way we've been emitting and get to 2050 and then turn off the tap. We have to get on the pathway now. But on top of that, most of the frameworks concluded that it's not enough to simply just change what you invest in. You actually have to work with the companies that you invest in to drive change. So, that involves engaging with governments, with your external managers, and with, high emitting companies. It means boosting your investment into companies that are aligned, so that have taken on net zero targets, or that are aligning, so the ones that maybe aren't quite on the pathway yet, but have a credible plan to get on the pathway. And then finally, the last thing that most of these frameworks ask you to do is to invest in climate solutions, which I think is also really important. So it's just a recognition that that we do actually need to put more money towards towards things that will actually solve this problem. So I guess I'll go through the different practical steps now to achieving this net zero target. So the first thing you need to do is actually understand what the footprint of your portfolio looks like. And in doing that, actually, the very first step is to select a metric that works for you and that's credible. And there's a lot of different ways to think about your emissions as an investment portfolio. The most straightforward one is to think about your absolute emissions. So how much does the total investment you make produce in terms of emissions? And there are ways of attributing emissions from the companies you invest in to your portfolio. Usually you take a percentage, the percentage that you own of the company, or the percentage of the total enterprise value of the company that you contribute to come up with an absolute emissions. But that's in some ways unsatisfying, because it doesn't capture the fact that larger portfolios will naturally tend to have more absolute emissions. It also doesn't reflect the fact that different companies that you own may be contributing useful outputs, albeit while producing carbon. So there are two solutions to this. The first one is what's often called the carbon footprint in investment parlance, and that's the amount of emissions per $1 million you invest, and that in some ways tidies up some of this problem. It reflects the fact that if you have a larger portfolio, you will have more emissions, but what's really important is how many emissions you have given the size of your portfolio. There are some weaknesses with this approach. In particular, it doesn't capture large changes in price can make a big difference to your carbon footprint, and it also doesn't capture sort of the meaningful output that your companies make. So, for example, startups do very well on this framework. The alternative is to look at carbon intensity, where you look at emissions per $1 million of revenue invested. Just a long story short here, there isn't really a right metric, but it's important for you to think about what you think matters to you. Then turning to how you actually do this, for listed equity and fixed income, it's actually really quite easy to source data from providers like MSCI. They now have tools that you can just plug in your portfolio composition, and it will spit out a footprint for your portfolio. For direct assets and external managers, I mean, you're really there. You've got to request the data, and where it's not available, what we do is we proxy that data by finding other companies in that sector and generally using the sector average to calculate the carbon. So that's how you do the footprint. Moving on to, once you've figured out what your footprint is, how do you reduce it? Well, it really kind of depends on your strategy. For passive listed equity, what you can do is either exclude the worst companies in the highest emitting companies or companies with fossil fuel reserves, or alternatively, you can tilt the portfolio so you can invest less in high intensity companies. For direct investment, it's important to integrate climate change consideration into both your asset allocation decisions. So to take into consideration how that particular asset will be impacted by climate change and change the valuation you assign to that company, but also in asset management decisions. So once you've bought the company, working with them to set credible targets. And the diagram down the bottom there is actually the framework that our FarmRight, our external manager who manages our New Zealand dairy farm and other rural assets, has set up. And I think what I really like here is it takes a holistic view of performance. It has business health alongside environmental healthy environment, healthy people, and healthy animals, which is a nice and holistic way about to integrate climate change into asset management. Now, finally, for external managers, we ask them whether they can meet targets or provide a low carbon option. And what we're finding recently is they've been more and more open to do this. And most managers now have a low carbon option. One thing I would just point out with external managers is one way to remove barriers that, resistance to adopting a low carbon strategy is to use a benchmark that is that aligns their incentives. So instead of using perhaps the S&P 500, use a low carbon S&P benchmark. Turning to engagement. So we do a number of things here. For listed equity, we join global collaborations. Some of our favorites are the Transition Pathway Initiative, the Climate Action 100 Plus, what was formerly known as the Carbon Disclosure Project and is now just called CDP, and the Investor Group on Climate Change. This really just helps us to multiply our impact because it is quite time consuming to do engagement. We focus our direct engagement on those where we have the most influence. We also vote all our shares on climate change issues, and we will always try and support climate change initiatives. For direct investments, as I spoke of before, it's about co-developing climate strategies. And for external managers, it's really making sure that their ESG stewardship policies and practices are aligned with our own. In terms of investing in solution, both passive and active, for listed equities, they're both passive and active ways of doing this. So, a passive way would be to select the top 10% of the 10% lowest emitting companies and buy an index like that. Actively, you can find managers now who are trying to invest in companies leading the energy transition, for example. There are also green bonds and sustainability linked bonds. And then in terms of direct investments, I've just highlighted three areas where we think are promising, but there are many more. But we've invested in a renewable energy company. We've invested in a number of clean tech. We haven't invested in agri-tech yet, but we might. It's an area we're considering in the future. One thing I would note about this is it's certainly an area that has developed significantly in the last few years. And then just on my final slide, I thought I'd touch on climate change and returns, because I think it's a big question for a lot of people trying to make this the shift, and it's been very important for us as well. So the way that committing to addressing climate change impacts the portfolio's returns, financial returns, in three different ways. The first is diversification. So if you commit to a lower carbon portfolio, that generally means you have to narrow your investable universe a little bit, because you're excluding some of the high emitting sectors, or at least reducing your exposure to some of the high emitting sectors. And that certainly is true. But on the right, you can see a graph of the impact of that on hypothetical returns. This was calculated by AQR, but I think I've seen many others that are fairly similar to this. And what that graph shows is that for the first 50% reduction that you achieve relative to an index, you suffer almost no loss. For the next 25%, you do suffer some loss, but it's relatively small. And it's really that last 25% that gets costly. So while diversification is a genuine concern for returns, I don't think it's really meaningful until we get up to very, very high levels of targets. The second way that it could impact returns is climate as a factor. So just like value or growth or momentum are factors that can impact financial performance, climate could be a factor. That's not to say it's one of those canonical factors that always delivers returns. All I'm saying here is that climate change could either increase your returns or decrease your returns purely because your exposure to climate is higher or lower. But if you think about it, to start with, if the market isn't taking into account climate change, then if you consider climate change, it will enhance your returns. And that was the super fund's position until very recently, that climate was not actually being considered at all. We've since relaxed that view a little bit, and we think that there are some cases where climate change is being considered, but we think on the whole it's still under considered. Now, in the future, that might change again, and we might see that the market as a whole is taking into account climate change. But then my response to that would be our focus will then become more on areas like engagement. And then finally, I'm just going to touch on this very quickly. The last way that this impacts returns is at the corporate level. So, there's a question of there's an additional cost taking into account climate change. But at the same time, you get a range of benefits such as marketing, staff commitment, and often, ultimately, you actually find cost-saving emission reduction techniques. So I will stop there. I'm sorry, I probably overran a little bit.
That's all right, Lucas. Thank you very much. Very insightful. Just on one of your points on the relationship between climate risks and returns, there was a study recently published in the Journal of Financial Economics, one of the top journals, showing that higher emission companies have lower returns, and that's across all listed equity globally over many years. So it's a pretty robust result in a top journal. Just thought I'd put that out there. We have some questions for you. So let's see. Graham asks, it seems like there's a huge opportunity for greenwashing and green wishing. How can investors trust the numbers of their portfolio companies, and how can clients of investment firms make sense of the reporting?
Yeah, look, it's a very good question, and I think it would be foolish for me to say that it doesn't happen at all. I think to a certain extent we have to do our best to avoid it, and live with the fact that we're working with imperfect numbers and trust that over time these numbers will improve and those who are greenwashing will get caught out.
Kind of a follow-on question from me. Who's going to catch them out?
Well, I think there's a lot of interest from a range of stakeholders, a lot of advocacy groups out there who are watching. As you mentioned in your introduction, I did a stint at Fonterra, and I can tell you, sitting inside there, it feels like the whole world is watching you. And and if anything, we were erring on the side of under-reporting our progress rather than over-reporting it.
Right. A sort of quicker question from Anonymous. What is the super fund split between equities and private market / direct investments?
So about 70% in equities, then probably about 20% in private markets, and then another 12% or so in fixed income.
And I'll just combine a couple of questions. There's a few that have been unanswered, but I'm sure you can reach out to the super fund through the website if you have the burning desire. So there's a sort of two questions. One is, will the super fund invest directly in New Zealand climate positive projects? And sort of a related question is, do you guys have a target in terms of percentage of assets under management directly invested in New Zealand?
So on the first one, yes, we will. Where we do struggle with is that projects still need to be of a significant size. So we can't invest in every project, in the New Zealand space. But where they are, of significant size, then we definitely do invest in them. We don't have a specific target yet. I can say that, definitively we want to increase our investment in that space. And we are looking at potentially setting a target in the future.
Great. Thank you, Lucas. And
Thank you.
maybe we should catch up sometime around estimating emissions data for our
Absolutely.
postdoc student.